example today of the cash flow statement. And as we mentioned, the two reporting formats, we always went through what goes in operating, what goes in investing, and what goes into financing activities. Operating activities is the only section of the cash flow statement where there is a choice in terms of reporting format. You could report on the direct format or indirect. Just realize the same cash flow results. It doesn't change the cash flow, regardless of how you piece that together. The direct format converts the income statement from a accrual to a cash basis. That's preferred by the FASB. The reconciliation format, that's going to be our focus and your responsibility once we get to the exam type issues that will come up on this. That's the most commonly used in practice in the United States. And if you had investing and financing cash flows, those are identical under any format. So it doesn't matter what format you use, the investing will be the same and the financing will be the same. All right, so let's take a look at the indirect. What you see up on the screen is the indirect reporting format. It is a reconciliation format. What it does is it takes you from net income on the accrual basis, makes a series of adjustments, and then brings you to the cash basis net income. So effectively, you're converting the accrual to the cash basis. Now, also, I'm going to do this by additions and deductions, but we'll talk further. In every section, or in every cash flow statement, I should say there are two sections. The first one deals with non-cash expenses and losses, non-cash revenue, non-cash expenses and losses. And that would be on your addition side. We'll talk about how that works. And then remember the operating cycle, remember all those ratios? Well, that's what's going to be built into this. We're going to tie it together, and then we have changes in operating working capital. On the deduction side, we have non-cash revenues and gains, and we have also operating working capital. So we've got two sections, and I'll show you how to put this together in a second. So let me explain the logic, and I've got some details for you in a bit. But if we start with net income, and we want to convert that to cash, we'll first look at these non-cash expenses and losses. Nothing to memorize because you're not going to have that many in this course because it's going to be limited. Depreciation, depletion, and amortization. Does depreciation use cash? No. Did it reduce net income? Yes. How do you convert it? Add it back. So take depreciation, add it back to net income, and you've effectively converted net income to a cash basis. So we're going to add back depreciation, depletion, amortization, and bad debts. What about if I paid you in stock options? I'm going to debit salary expense and credit common stock. Did I use cash? No. So I add that back. So non-cash expenses, and I'll show you numbers in a second, but as I always do, concept, practice, application. Let's get the concept first. If an expense or a loss does not use cash, you add it back. If it does not use cash, you add it back. Another example, which we'll spend a little more time on, loss on sale of long-term assets, whether they are plant assets or investments. And remember, the exam, which we'll get back to in a bit, you had a loss from discontinued operations from remeasuring the division. Did that have any cash flow? No. It was just simply taking a fair value against a carrying value. So those losses will be added back. Then the operating working capital. So what do we say about asset accounts? Asset accounts are inversely related to cash flow. So if current assets go down, cash flow goes up. If trade receivables go down, what does it mean? You've collected those receivables, you have more cash, cash goes up. Inventory goes down. You assume that you sold it, or at least if you did sell it, you didn't have to buy it because you already had it in stock. So that does not use cash. If prepaid expenses go down, realize that this is just like depreciation. How does a prepaid expense go down? What does it look like? Let's say we have rent expense. 400 prepaid down. So prepaid rent goes down, it's like depreciation, it doesn't use cash. When prepaid rent goes down, it's a non-cash expense.
Will you please explain the same thing for trade receivable?
Yeah, trade receivable. Let's say you have a decrease in receivable. How does a receivable decrease? Go to cash, credit accounts receivable. So if the receivable goes down, that means you collected the receivable. Cash goes up. So if the receivable goes down, you add it.
But you know, it's not supposed to be operating non-cash.
It's called operating working capital. The other term for it is non-cash. In other words, working capital items other than the cash account. Other than the cash account. So what this term means, and you gotta get used to the term, it means that these are operating working capital accounts other than cash. Other than cash. All right, so what about liabilities? If current liabilities go up, what does it mean? They didn't pay for an expense. Yeah. Yep.
So, how do you recognize when you are in?
Yeah. Okay, we're going to do that now. I'll jump to that. I'll come back to it. So the question was, what if a prepaid expense goes up? When you first acquired this, it could have been a debit to prepaid. Let's say it's the same amount. Prepaid rent and credit what? Cash. So an increase in prepaid rent uses cash. So that's why down here, if prepaid rent goes up, it's a deduction from the cash flow statement. It's a deduction. And again, the old standby is, look, if an asset goes up, it uses cash. If an asset goes down, it provides cash. And that's just without, I want you to understand it, but that's where it comes from. All right, what about liabilities? Liabilities are directly related to cash flow. So if accounts payable goes up, those are expenses you didn't pay, you got more cash. Accrued salaries, debit salary expense, credit salary payable. Debit utility expense, credit utility payable. As those utilities go up, you didn't use cash. Now, those expenses reduced income, but you didn't use cash. So these are add-backs. Now, on the deduction side, we're not going to do any bonds this semester. We'll talk about gains on long-term assets. What about a recovery on a remeasurement of a discontinued operation? That did not provide cash, so you do what? You subtract it. So any gains that don't provide cash get subtracted from income. And then, increase in accounts receivable. Sales you did not collect, subtract it. Sales you did not collect. So you've got sales revenue, but you don't have cash. What if all of your sales are on accounts receivable? So you have debit to accounts receivable, credit to sales. Say it's 500. Accounts receivable goes up, no cash flow. So if accounts receivable go up, those are sales you did not collect. Inventory goes up, you assume you paid for it in cash. Prepaid expense goes up, Dan just asked the question, it's going to use cash. Decreases in current liabilities will also use cash. Accounts payable goes down, your credit card bill goes down, paid it off. Accrued expenses, tax payable goes down, wages payable drop, we paid it off. So when liabilities go down, we subtract them. Now, after making these adjustments, you're going to convert net income to cash from operations. Now, in the discussion, these are most of them are relatively easy to understand. But what I've done here, what I want you to do, this is for you, because I'm going to keep repeating this when we go through our example a little bit later this morning. But this is a good table to use as a reference to study from. So, just taking the receivable again, and he explains it, that if accounts receivable will increase, an increase in trades receivable or sales that are not collected. Right? So if receivables go up, it is inverse to cash flow. If receivables go down, it means that it implies that not only were all of this year's sales collected, but some of last year's. If the balance of what people owe you dropped, even though you had sales this year, you must have had all of your sales collected from this year and some of last year's. On an implication, may not be true, but it's just the way we look at it. So all of that I'd like you to study. Now, the one that is a bit problematic, if you turn to page 9, is the gain or loss on the sale. So why is it that we add back losses on sales of assets, whether they're plant or investments, and why is it that we subtract out the gain? Well, first of all, under the indirect method, this paragraph is important in terms of theory, your understanding of the concept. And that is that we basically reclassify that gain or loss out of operating activities and put it into investing. So when we look at operations, this is the cash flow statement. So we're going to reclassify that gain out of the operating activities and actually move it to investing. And I'll show you how it's done. The other reason for it is, if you think about it, that gain really wasn't part of normal operations. You're not in business to sell off your planned assets. So in a way, it's a correction, right? So if you take the gain out of operations and only reflect it in investing, it makes more sense because that's not part of your operations. The other reason is that the gain or loss does not provide any cash. It's really the selling price that does. So for example, and I'll show you another illustration in a second. If the selling price is $6,000 and the net book value or carrying value is $5,000, that's the gain. So what provides the cash? It's the selling price, not the gain. The gain does not really provide any cash flow. It is the selling price. And then if we didn't reclassify, we double count. Because in investing activities, as we'll see, we're going to have sale of planned assets. And that's when you're going to add the $6,000, I should say, $6,000 cash flow, and as part of what you would have in your cash flow statement, because if you left it in there, you'd have a problem because you're repeating it here. Now, what some students might want to do is put $5,000 down here and keep the gain up here. Not the correct approach. Not that it's going to get you to the wrong cash flow, but it's not the correct approach. So we remove gains and losses out of operations and make sure that the cash flow is reflected in the investing activities. So now let's do this example, another illustration. So let's assume that you've got a company that sells an asset for $1,000. The carrying value of the asset in entity A is $800, while B has it in $1,350, and the difference has to be depreciation, right? So entity A probably used an accelerated depreciation. The net book value, the carrying value is a lot lower than if you use straight. So if you look at this, same sale, absolutely the same event, but the gain for entity A is 200, but there's a loss on the books of entity B for 350. When we use the cash flow statement, this is one of the tricky areas, but we want to be sure we have it before we start. What we're going to do is, assuming that this loss or gain is the only part of income that you have, what we're going to do is subtract the gain and add back the loss, and the cash flow from operations related to that sale should be zero. And then, in investing activities, you've got the sale of the plant asset. So the cash selling price goes into investing activities where the gain and loss have no cash flow implications. So what you have to do is just realize that that's the style that we're using. Nothing wrong with, you're gonna get the same result if you left the gain here and made this 5,000. Right? Same thing here. Nothing would change if you left the gain up here and made this 8, or if you left the loss up here and made this a positive 1350, you get the same cash flow. And that's going to be the biggest problem that you're going to find when you do a cash flow statement. The problem is you know the change in cash. If you took two balance sheets, you'll know cash went up by a certain amount. So this is one of the only problems on the exam that you know the answer before you start. The only problem is getting there. And you can spin the numbers a million different ways and you'll get those answers. Right? You can, if you want to, play with numbers enough and you'll get cash changing to that amount. The trouble is it's got to be in a certain format. So you must eliminate the gain and loss in operations and put the cash selling price in investment. So that's point number one. You have to be careful to look at the time. Yeah. Yeah, there's a lot of, in terms of this sale, you mean, or? Yeah. No, that would be it, just related to that sale. Now, in reality, you'd have more than this gain or loss in operations, because that would be buried in net income.
I'm wondering if like the always close out, like with operating cash always close out.
To zero? No, because net income and net loss would have multiple items. That'll be your bottom line net income. And this is just for this one transaction. So I'm just isolating the transaction. So. Any other questions? Now, so let's now look at Johnson & Johnson. It's a little bit larger so you can see it. So here's a sample. And, we talk about applications, concepts, practice, applications. Here is the application of the cash flow statement on an indirect basis. Notice it is a flow statement. It's for the year ended. And it is also 3-year comparative like the income statement. We start with net income, and there's always two sections. The first section is going to be the non-cash revenues and expenses. The second section is the change in operating working capital. So let's just do some of these. We're not going to know how to do all of them, but net income. How do you convert net income from the income statement? I'm going to show you where that comes from in a second. How do you convert net income on the income statement to cash from operations? Add back non-cash expenses. Depreciation, depletion, amortization. Doesn't use cash, you add it back. Stock-based compensation. I pay you in shares of stock instead of cash. No cash flow, add it back. Asset write-downs. This is an impairment, a remeasurement of an asset. Doesn't use cash. Add that back. You have other gains here that may not have used cash. The bad debt expense, let's go down here, accounts receivable allowances. Depending on the change, it could be an increase or decrease, but the bad debt expense, the allowance for bad debts, is not a cash event. So these are the adjustments that you make. And then you go into the second part of this, which is the changes in the operating working capital account. So that's section number 2. And changes in operating working capital will be accounts receivable goes up, sales you didn't collect, you subtract them. inventory goes up, you could assume that not only did you sell inventory, you had to buy inventory to sell it as part of cost of goods sold, you also increased the stock in your warehouse. So you had to buy even more inventory, more cash flow. So when we look at inventory going up, what we're saying is that you had to have enough inventory to sell it, and you had to have enough inventory to stock your warehouse in addition. So that additional stock, the increase, is a cash outflow. Accounts payable goes up. Add back $955 million because those are bills you didn't pay, those are salaries you didn't pay. If you take a look at other non-current assets, other changes, it could be prepaids in there. Whatever it is, these are the operating working capital accounts. That's your cash from operations. Notice that the company's generating $18,471 million in cash from $16 billion of income. So your income on the accrual basis is generating $16 billion, while your cash flow is $18 billion. So this is giving you an indication that the operations are of a higher quality, in the sense that you're able to generate more cash than your reported net income. So it's what cash flow is generated from operating activities. Now, did you convert from an accrual to a cash basis? Yes. But the cash basis is not the highlight here. The highlight is you've got accrual basis net income that now will generate a certain amount of cash. So you're trying to determine how much cash is generated from that net income. Now, the rest of this, we're going to do an example in a bit, but the rest of this is investing activities and financing. What goes into investing? Plant assets, investments in securities. So if I add to property, plant, and equipment, it uses cash flow, correct? If I buy more plant, I use cash. If I dispose plant, if I sell it, that provides cash. That adds to my cash flow. Purchase investments, go out and buy securities. That's going to use up cash flow. And if I sell those securities, I'm going to have cash inflow. So this section is, I think, relatively logical. That when you buy plant, you use cash. When you sell the plant, it provides cash. When you buy investments, it uses cash. When you sell those investments, it provides cash flow. Now, in this case, they've used up $12,305 million. What about financing? Financing cash flows, dividends paid to stockholders use up cash. Buying back common stock uses cash. What do we mean by proceeds from long-term debt? You borrow money. And if you borrow money, cash goes up. You retired debt, paid it off, so that it goes down, cash goes up. And the same thing's true here. Financing uses up $12,260. Forget about the exchange rate. That's something you'll see in advanced accounting. There's always going to be, on the bottom of the statement of cash flows, there's always going to be a reconciliation. And that reconciliation will always show you the change in cash plus the beginning is equal to the end. So on the bottom of the cash flow statement, it's required. This is something you have to know. You've got to put this together. You need a reconciliation at the end of that statement. Now, we're now going to look at something that is extremely important, not only in this course, but in all courses, and that is the idea of articulation. The statements definitely tie together. And the reason why the FASB likes this format is because everything links. So, for example, let's start with net income in 2014. So, it's right here. We have 2014 net income. And just as a reference, it's 16,323. And cash at the end of the year. We go down to the bottom line cash flow statement. The ending cash flow is 14,523. Now, this concept of articulation means the statements tie together. So the reason why the FASB really likes the indirect method is that it gives a user a sense of confidence that they can track those numbers. Where are you going to find, what statement would you find that income on? Income statement. So if we go to Johnson & Johnson's income statement, which is on the next page, net income is going to be 16,323. Right? So now the income from the income statement is the first line on the statement of cash flow. So now you've got a basis for verification. The numbers tie together. And where would you find cash? Balance sheet. Cash and cash equivalents on the balance sheet, 14,523, and that's what you find on the cash flow statement. So the statements are looped or linked together. Remember I showed you a diagram on Tuesday. The statements will link together. Balance sheet, income statement, to cash flow, and then back to the balance sheet. So that's the financial reporting cycle. Now, there's one other thing to show you here before we take some questions from you, and that will be, on the bottom of the statement of cash flows, this is Johnson, somebody asked me this after class on Tuesday, but Johnson & Johnson does a pretty good job of disclosing this, so I happen to like the disclosure, is that, remember we talked about non-cash financing and investing activities, we talked about buying a plant and signing a note. Well, right here, they issued common stock to acquire another company. So they issued stock to buy another company. So I give you stock and you give me the shares of your stock. Or I give you shares of stock and you give me your business, essentially, your assets come over to my company. So that this now becomes a non-cash transaction that has to be reported. It's not the cash flow statement, but it's got to be reported. And here, treasury stock given in stock option plans. So I basically would kind of debit salary expense and credit, or use them for treasury stock. I got rid of the treasury stock. And I would have that as a non-cash. Conversion of debt. I take the debt off my books and issue common stock, right? Convertible debt, that's what it means. You convert debt to common stock, non-cash. So that is disclosed. This could also be shown in a footnote. And finally, in addition, you always have to show, on the indirect basis, interest and taxes paid. Interest and taxes. So you always have to show interest and taxes paid. I'll show you how to get that, and I'll show you why we do it. So that is the indirect reporting. I'm going to go through examples. I've got self-assessments, but that's the general form. All right, so any questions so far on the general form of that? So we start with operations. Two sections of operations: non-cash revenues, gains, expenses, and losses. Second section, operating working capital changes in current assets and current liabilities. Those are the two sections. Come down, investing, financing, and then the reconciliation.
Why is that with gain on sale increasing?
I'm sorry?
Why is the gain on sale decreasing on the Is that a loss or?
Right here. Oh yeah, the gain on sale, where it's the same story here. We're taking it out, and then we're including the selling price in investing. So that right here, as part of the selling price, proceeds on the sale of assets is $46.31. You can't see it exactly. When we see our sample problem, it'll be easier to see. So the gain comes out of operations, but the cash goes into investing.
Because I saw it was blank.
It, I thought you meant the investments here. Yeah. This one, that gain on sale of assets is $23.83, and for investments, it's blank. There's no gain or loss that year. All right, so any other questions? Yeah,
With regards to dividends,
yes.
the question says dividend declared. Then how do you address?
Good question. Dividends declared, but not paid. They're not paid. They're part of the non-cash disclosure. They don't go on the cash flow statement. So that's a great question. Here we go up here with like conversion of debt. So when you declare a dividend, debit retained earnings, credit dividends payable, no cash flow, doesn't go on the statement. And it's not part of operations either. So dividends declared but unpaid go into that section. Not part of the cash flow statement proper, but it's a disclosure. Supplemental, right here, the supplemental disclosure. Good question. Okay, any others? I want to show you a little bit about indirect. You have a little bit of responsibility for the indirect method, not a lot, but I want to compare it and, I'm sorry, the direct method, excuse me. So I want to share a little bit about the direct method. And as I said, you're not 100% responsible for this. There are some cases where you may have to use some of the calculations, but the direct method will disaggregate, will take the income statement and break it out line item by line item and convert each line from the accrual to the cash basis. So you will see something like this. Cash collected from customers, interest and dividends received, other operating cash received, cash paid to employees, interest paid in taxes, other operating cash disbursements. So these will be line items. Now, how do you get them? Well, we're going to see a couple of things in a second, but let me just give you an example. Sales. If you took accrual basis sales and subtract out the increase in accounts receivable, or if there was a decrease in receivables, you would add it, that would give you cash collected from customers. So, for instance, if you had, let's make a journal entry. Well, let's just say you had cash of 100, and you had accounts receivable of 900, and you had sales of 1,000. And that's booked in your ledger. In order to do the direct basis, you would have to take the accrual basis sales, which were 1,000, and you would have to deduct, you'd have to subtract out the increase in accounts receivable. And it's extremely logical when you make journal entries. Always make a journal entry. It's the simplest thing to do, and you'll see how this will work. So if accounts receivable goes up by 900, I would report cash collected from customers at 100. That's the way I would report it. So I know if you see the journal entry, it looks obvious, but remember, you're dealing with large corporations or even in homework problems where you don't see all of that. So that is an example of the direct cash flow approach. If receivables happen to go down, you would add it. So if you looked at your T account, and we'll see some examples of that, what you do need to know sometimes, especially for the direct method, would be for the indirect method rather. Remember, you have to disclose interest paid and taxes paid. So let's say you had interest expense of 500, you paid 300 in cash, and interest payable goes up by 2. there's an increase. Now, issue is, you don't necessarily see this, but what if I told you that the expense here is 500, and there is a increase in interest payable. Notice the increase in interest payable is added. And that's going to be for 200, and what that will do is get me to the outflow of 300. Let's say you paid out 900, interest expense on the income statement is 4, interest payable is paid down by 5. How would that look on the statement of cash flow? Well, on the accrual basis, you're showing an expense of what, 400? And here, I'm going to subtract an increase in interest payable. So the cash paid for interest goes to 900. So that's the logic behind it. Think about journal entries. It doesn't make sense. We're going to see a lot more of this as we go. And taxes are the same. Most operating expenses are exactly the same as this. We're not going to do them all because you're not going to be responsible for this. It's good that you know. We'll show you where taxes, where that comes in. Tax is the same thing. You won't be dealing with deferred taxes in this course, so you'll only be dealing with the tax payable. Now, here's a real, I think, important illustration for us. And that's going to be the following. I want to compare the two methods. So let's say I give you the following information. I tell you that we've got sales of 3,000, we've got depreciation expense of 6, I've got SG&A of 4, selling general administrative expense, I've got tax expense of 200, and I've got net income of 1.8. I also have an increase in accounts receivable from balance sheet information, increase in accounts receivable of 200. I've got an increase in accounts payable of 100, and I've got a decrease in tax payable of 1. I want to come up with the cash from operating activities. Now, if I'm using the indirect method, you start with what number? Net income. Okay, so put that right here. You're going to start with net income. When we look at the adjustments, the only non-cash expense I have here is depreciation, so I'm going to add that back. Accounts receivable go up. Sales you did not collect, so you subtract. Payables go up. Expenses up here that you did not pay. So I'm going to add that back. And if tax payable goes down, not only did I pay for the taxes that I expensed, but I paid for some of last year's taxes. Right? If your tax liability drops, it has to be paying off some from last year as well. So when I calculate cash from operations, I take net income, I add back depreciation, because it's a non-cash expense. I then will have an increase in accounts receivable being deducted because those are sales I did not collect. I also have an increase in accounts payable being added because those are expenses, and Tony's was your question before. Notice that the income line is aggregate, so you don't see it directly. That's why we call it an indirect method. But you are indirectly now taking 200 away from sales. You're indirectly adding back and reducing expenses because you didn't pay for them. And for the taxes, you're indirectly increasing that outflow because you paid more than the actual expense. Now, I get an operating cash flow here on a direct basis of, let's highlight that for you, of 22. Now, if I was doing this, and I'll take your questions in a minute, but if I wanted this on the direct basis, you notice you're going to make the same adjustments. The indirect is kind of vertical. The direct is sort of horizontal. Now, by the way, this is not a statement. A lot of you are going to see on your exam comments, well, that's not really a statement. This is a worksheet. So what I'm going to do is I'm going to take sales, and I'm going to subtract out the increase in accounts receivable, which gives me what? The cash collected from customers. You don't see that when you apply it against aggregate net income, but when you take each line item, you convert sales to cash collected from customers, $2,800. Depreciation expense, most people tell you just ignore it, but what you're doing in effect is taking the 600 and adding it back. Selling general administrative expenses, $400, but if payables went up, that represents amounts I didn't pay. Notice these are the same adjustments you made up on the indirect method, so that the actual cash you paid was $3, and for taxes, you expensed $200, but your tax payable went down. Not only did you pay for the $200 this year, you paid for some of last year's, so that your tax expense is $3. When you come up with that amount, you're going to find out that cash from operations is the same. Cash from operations is the same. Now, this would not be acceptable if I were to ask you to do a direct method cash flow statement. This is not a statement. This is the statement. That is a worksheet. Computations only. The statement looks like this. Cash collected from customers, $2,800. Cash paid to suppliers, -3. Cash paid for taxes, -3. And operating cash flow is 22. That's the statement, the section, rather, the operating activity section on a direct basis. So, same adjustments, same result, different format. Now, this is the extent to which you would be responsible for the direct cash flow. We're going to move right now to the next module. I'll give you the answers to these questions at the end of the module in a second. What I want to do is go to an actual problem on an indirect basis. But you do need to be familiar with the direct cash flow method in general. You're not going to be asked to put a statement together, at least in this course. Doesn't mean it's not on the CPA, but you will see it in Intermediate 2. The last chapter of the book has the cash flow statement. All right, so before we move ahead, anything else on direct versus indirect? What I wanted you to do is get a picture on one page to visualize how they look. This is the indirect. Start with net income, make the same adjustments you make here, and this is the direct method. Right there. Yeah.
So does that it's more difficult to see? I don't see that.
What's that? It's more.
The direct method is more difficult to see.
Yeah, I mean, it's more difficult for the user to find those numbers. That's the point. Now, although there are disclosures from the FASB standpoint, the indirect method articulates better. That's why I brought that up before, because you can tie the numbers in. I mean, how can an average user find cash collected from customers unless they have enough accounting training to do that? And that may not even work because there may be other adjustments. The other thing, however, why is it preferred? It's preferred because if you want to make a forecast, which is more accurate, forecasting cash flow of 2,200 on an indirect basis, or forecasting each one of these individually and coming up with a cash projection. Individual is more accurate because when you aggregate numbers, there are noise. There's noise in there. You don't see the actual flows in each. See, I know.
I was basically asking, isn't direct more understanding? Not the
It's, well, it makes more sense from a logic standpoint, but the FASB's argument is that it does not tie into any other statements. So you can't, as I said, you can't find cash paid to suppliers. You could not recreate that number. But you could, for the most part, although there are adjustments, you could find that income. You could find receivable changes. So a little easier. Doesn't mean that an analyst can't cope with the direct method, but that's their argument. Now, what makes the argument even worse is that the bottom line is that you do get disclosures like this in a direct method cash flow anyway. So it kind of ties things together. I think it may be very well be that the ability to forecast is maybe a little bit more difficult with the indirect method. Maybe more difficult to put this together on a direct basis, I'm not sure, internally. So, but in practice, that's what we've got. It's almost, well, it's very difficult to find a direct method cash flow statement used by a U.S. corporation. If you search Edgar, you search the SEC documents, you search any other report, it's pretty difficult. But that is a good question. I mean, I agree with you, and analysts will agree with you, that this approach, direct, is easier to forecast. And you get more accurate forecasts by using the direct approach. All right, so now, let's take an example. And what I want to do is I want to go to the next module, and I'd like to go through the illustration. And we're going to build the cash flow statement. So this is the Gibson Corporation. What I've done here is I've combined, it's on module 6.4, page 1. I've combined the income and retained earnings sections. We're going to do indirect format. Okay, so what are we doing indirect in this module? Some direct calculations are needed. We'll get to that in the disclosures. So we have sales of 500, cost of goods sold of 120, purchases 560, goods available for sale 680 minus the ending inventory gives me COGS of 380. I then have a gross profit of 120. When I look down at the expenses, I see I have SG&A of 30. I have depreciation, and I'm just going through my logic here. I will say that I want to look at this because I know I need this as an adjustment. I also don't see any gains and losses in here on sale. I've got tax expense and interest expense, which I know I've got to disclose. I've got net income. I have beginning retained earnings, less dividends. Now, these are going to be, I'm going to put this in parentheses, this is going to be dividends declared. I'm sorry. Not necessarily paid. So you would have to look at the balance sheet to see if there were dividends payable. If there are no dividends payable, everything's been paid. So what you see on a retained earnings statement, is going to be declared, but only paid if there are no dividends paid. And we have to check the balance sheet. So let's go to the balance sheet. What I've done, I've given you the balance sheet. And we've got cash and cash equivalents for each year. There's unclassified balance sheet, receivables, inventory, prepaids, plant assets, and accumulated. Then on the liability and stockholders' equity side, accounts payable, accrued tax payable, long-term debt, cap stock, and retained earnings. Now I give you additional information. So when you put a cash flow statement together, this is very procedural right now. When you put a statement of cash flows together, what you need, income statement, 2 balance sheets, and additional information. So now I'm telling you that Gibson paid $105 in cash for new equipment and financed an additional $22 by borrowing the full amount. So when I look at property, plant, and equipment, well, actually, let me put this in investing activities, because that's what it is. I know that I've got 127 in capital expenditures. Or the purchase of planned assets. All right, so we purchase property, plant, equipment. I know that out of that amount, I've got 105 in cash, and I got 22 borrowed. Now, I want to be sure is that we understand that the cash flow statement is going to include this transaction. The borrowed transaction is going to be disclosed. I'm going to put a note there for you as well. Then in financing, we know we borrowed right here an additional 100. We have 22. Let's have this ties in. Finance, property, plant, and equipment. Now, while I have financing activities up here, we also know, and I'll scroll this back up, we've got dividends declared. Of 12. We have to see if they're paid. We have to check that out in a second. Wait, and then going back to the additional information, says plant assets were sold for their book value, and you received 165 in cash. So if you sell an asset for book value, there's no what? Gain or loss. So there's no gain or loss. And that is consistent with what you saw on the income statement. There was no gain or loss. So also now the sale of PP&E, and that's going to be for 165. So how do you prepare a cash flow statement? Income statement, 2 balance sheets, and additional information. The additional information is probably the most important. Probably the most important in pulling this together. I also know one other thing. We also know that from the standpoint of important items, we've got depreciation expense, 22. And that came from the income statement. You can check that. Let's go back here. It's one of those items that I highlighted before. We'll get back to the interest and taxes. Now, this is very mechanical from this point on, with lots of explanation, as you'll see. When you solve either method, the first thing you need to do, and if this was an exam, what I would say is, and will be the next exam for sure, I would basically just go on the paper, exam paper, put the changes right here. Increase or decreases in all these items. I'm going to do that for you right here. So you should do 2 things. Get the change and classify the change. Get the change and classify. So cash. Cash goes from 85 to 60. It drops by 25. First line up there, cash and cash equivalents. That is your answer. So that's the good thing about a cash flow statement, you know the answer. So the bad thing is you got to try to get that. So, and I will tell you now that for the exam, it's more important to get all the line items done. So I've seen people, oh my God, the cash flow statement did not come out to minus 25. What do? Spending 45 minutes staring at it, trying to find out. The best thing to do is just go ahead and move on. Because you might have put a number in the wrong direction. You might have added when you should have subtracted something. You're not going to find it. The line items are the most important, as we'll see. All right, receivables. Receivables go from 70 to 95, up by 25. And that's an operating activity. Inventory goes up from 120 to 300, goes up by 180. That's an operating activity. Prepaid expenses go from 90 to 140, up by 50. That is an operating cash flow. Plan assets. Now here's the problem. When you look at, and I'm going to stop here because once we look at these operating activities, I can accept those numbers on a net basis. So operating activities, we always use the net result. So in other words, I don't care if accounts receivable went up by $1 and sales were $1,000,001 and collections were $1 million. All I need is the dollar. I don't care if you had $1,000,001 sales and $1 million of collections and the receivables went up by $1, I'm going to use the dollar. But the problem is, when you get to investing and financing, we have to use a gross change basis. And here, operating, I can use a net change basis. What that means is that any of those change, inventory, 180, I don't care how you got 180. Like I said, you could have bought $2,180,000 worth of inventory and sold $2 million. We don't care. We just want the 180. But what we do care about is here. Now, does this number make sense? Could you say unequivocally that the plan assets went down by 61? Well, I got more information here that tells me that can't be true. Because I bought 127 worth, I sold 165, that's the net book value. I don't know how much I actually sold, so I can't say unequivocally it's 61. I also know that the depreciation is wrong because it's telling me the depreciation went down by $1, but I know that I depreciated it by 22. So what you need to do with investing and financing cash flows is work on a gross change basis. That means you need to analyze all the T accounts. Now, textbooks would tell you, make T accounts for everything. I think that's nonsense. You only need to make T accounts for investing and financing. You don't need to make T accounts for operating activities. Depreciation is going to be made up of the sale and the depreciation expense. Same thing's true down here. Operating cash flows, net changes. Accounts payable went up by 3. Accrued taxes went up by 20. That's all I need to know. But long-term debt went up by 122. Now, I happen to have the answer already because I know what happened. They borrowed 100 in cash, and they also borrowed or financed the property, plant, and equipment the other 22. So I've already got that change. But sometimes it's not that easy. You've got to use T accounts. And if you remember, when we were reviewing Chapter 4, I talked about accounting gymnastics, where you got to kind of back into numbers and work through T accounts to get those numbers. Well, in this case, you don't need it. Capital stock, there's no problem. No change. Retained earnings went up by 40. Well, I'm sorry, went up from 40 to 65, went up to 25. But I've got dividends of 12. So what happened? Well, we've already got this kind of mapped out already. Because if you look at the income statement, we know that net income was 37, and we can account for that change very easily because we know that there were dividends of 12, and that's where we know it went up by 25. We'll talk about that later. Right? So net income of 37 minus the dividends of 12 gives us the 25. So you've got to account for all of the changes when we deal with investing and financing cash flows. So that $25 here, we know it's net income minus the dividend. Net income minus the dividend. Now, I want to do those gross change analyses. The only accounts that I have to analyze are going to be plan assets, and accumulated. Long-term debt, cap stock, and retained earnings. That's it. The other accounts, I don't need to analyze. In fact, I don't need to analyze cap stock in this case, or the T accounts. What I'm going to do is I'm going to see if I can find out the missing information. So I know the plan assets started with 255. I know they ended at 195. So I know there's a drop in there. I know the change happened to be 61. How do I account for the change? On a gross change approach, you've got to account for the change. What happened? Well, what do I know? I know there are acquisitions of 127, correct? Got that number. Balance sheet doesn't balance. I mean, the T account doesn't balance. So I must have sold equipment for 188. That's the plug. That would be the plug, because this would not balance out unless you had 188 sold. Now we know the equipment is sold. On the depreciation, remember we said it went down by $1. It went from 100 to 99. But if you depreciated 22, well, the only thing that could happen is you remove 23 when you sold it. Like when you sell an asset, you got to remove a book value. So the difference between the asset sold at cost and the depreciation removed on sale is how much? 165, which is the book value. Right? Because we told you before that the asset was sold at its net book value. So now you can check that off your list. You've got that covered. So basically, this means that the net book value of the asset I sold is 188 minus 23. You could have done this in tons of different ways. You could have said, hey, the depreciation account's kind of easy. I can do that in my head. I sort of know that 23 came off here. So I guess if I know the asset was sold for book value, and the book value is 165, then I must have taken 188 out of the, so you can kind of back into those numbers if you can figure it out. So the net book value of the asset sold was 165. So you got it. The other accounts are easy. We know these, but I'm just showing you this for practice. Retained earnings started at 40, ended at 65. We know we have net income of 37, so dividends declared at 12. If you didn't see that on the income statement, you'd have to back into that. That's what balances that account. And what I'm saying here, maybe you want to see what would have happened if I didn't take the dividends out. My balance would be what, 77. So the dividends have to come out. Dividends have to come out. And then the long-term debt, I know, started with 100, ended at 222, and we know that we must have borrowed 122, but we also know that 100's in cash and 200 was used, 22 rather, was used to finance. So that's the procedure. 2 balance sheets, get the changes and classify them. Income statement, look for information that you're going to need. Gains and losses on sale, depreciation. Look at all the additional information. Only investing and financing accounts need to be analyzed. When we say gross change, we need to know the inflow and the outflow. So what I'm going to need to know here is how much equipment did I buy and how much equipment did I sell. I just can't net it out. That net for 61, would you get the right answer? Yes. Is it correct? No. So even though you would get the change in cash at 25, it's not going to be correct. Let's see how this would be put together. And this should actually be not direct, it's indirect. So it's only, this is not, this shouldn't be direct. So it's only under the indirect. Yeah. Yes, Juan. Decrease in retained earnings that would mean you have a net loss, or the dividends were greater than income. So here is your solution. And you would have the heading, name of the company, statement of cash flows, put in direct method. There's a flow statement for the year ending. This should actually be, it doesn't have to be income from continuing. In our case, it doesn't matter, but I think we should always call that net income. So let me just change that for you to make sure. So that's always the starting point. Sometimes we start with income from continuing, but two sections. The first section is going to be non-cash expenses, revenues, gains, and losses, and the other is going to be changes in operating working capital. The first thing I do, so let's start with net income. That came from the income statement. Make sure you go back and track it, keep that page open on page 1. Net income is 37. Also on page 1, you're going to find an appreciation of 22. That is added back because that's an expense that did not use cash. Then if you go to the balance sheet changes on page 3, increase in accounts receivable, sales you did not collect, you can subtract it. Increase in prepaid expenses. Dan, you had a question before. When a prepaid expense goes up, what happens? Debit, prepaid insurance, and credit cash. So that's an outflow of cash. And again, don't like to say this, but if you're stuck, if an asset goes up, subtract it. It's inverse related to cash. You assume it uses cash. Inventory goes up. Why does it use more cash? Because not only did you have to have enough inventory to cover your cost of goods sold up in net income, but you also increased the inventory in your warehouse, so you had to buy more. Did you pay for all of it? Well, if accounts payable go up, not necessarily. So you add that back, and taxes payable went up, didn't pay for that either. So that if liabilities go up, you add them back. And your cash from operating activities is minus 173. In this case, we're getting a little bit of an opposite effect. We've got net income of 37, but we've got outflows of 173 from operations. Here, your operations are using up more cash than the income you've generated. So that's the indirect method. Now, we're going to go over a lot more problems on this. In fact, when we get back next week, we're going to go through lots of the questions in the back here are very good, and we've got a self-assessment also. Any questions on operating cash flow? And I think there's homework on this too that you do. Indirect is the only response code we have. Now, as I said before, if the rest of the statement is wrong, doesn't matter, you're going to get points for each line item. So you should not, for example, if cash receivable goes up and you add it, wrong. But if you subtract it and it's the correct number, you've got some credit. So you don't necessarily have to get the 173 on the exam. And you'd like to see you do that, but you don't have to. Now, investing cash flow, what do we know? You received 165 on the sale, and you bought equipment of 105. Why isn't it 127? What's this 22? The 22 is property, plant, and equipment, notes payable. Did not use cash. It has to be disclosed, but cannot go on the statement. It's a significant non-cash investing and financing. So by selling the equipment for 165, buying equipment for 105, you generate $60 in cash from investing. And then finally in financing, you've got proceeds from issuing long-term debt. And once again, it's only what? The 100, because that's going to be cash and notes payable. You don't include the 22. And then dividends paid. How do we know they're paid? They were declared. How do you know they're paid? If you go back to the balance sheet, and I do not see any dividends payable in here, that means that all dividends declared are paid. All dividends declared. Now, once I put that together, I've got cash flow from financing at 88, cash flow from investing at 60, and I used 173 in operations. So the net decrease in cash and cash equivalents is minus 25. Now, I got this right at home, but if you don't get that answer, not the end of the world. Everything else in there could be correct if you stated it wrong. So we'll talk about this more. We have the next test. You do not spin your wheels trying to get to that number. Because you could. You might change something else and make it worse. And of course, the last thing you have to do on this statement is you must reconcile beginning and ending cash flows. You have to reconcile the beginning and ending cash flows. So you take the change in cash plus the beginning cash gives you the ending cash flow. And that ties back to the balance sheet. All right, so I'm going to ask you to work on this problem. When we get back next week, we're going to do the disclosures. We're going to do some problems in the back. We're going to talk about IFRS. And we're going to move to Chapter 9. The Chapter 9 tends to get a little friendly because we start talking about accounts receivable, the bad debt allowance, something you've seen before, but then once again we take off to an intermediate level. All right.